Welcome. We're about to jump into a really key part of AS level accounting, how we handle irrecoverable and doubtful debts. This isn't just theory, it's something every business with credit customers has to master. Let's make it simple. Offering credit is a fantastic way to bring in more sales, but it always comes with that one big question looming in the background. What do you do when a customer just doesn't pay? How do you make sure your financial statements tell the true story?
Hello kids, this is your very own accounting teacher Adeel Paperwala. Welcome to my YouTube channel. Before watching this particular video, remember if you want to achieve excellence in accounting, you can also opt to enjoy my live classes for O-levels, IGCSE, AS and AT. If you want to study at your own pace, you can also opt to acquire my live recorded online classes as well.
So here's how we're going to break it all down. First, we'll nail down the definitions. Then we'll get into the idea of provisions and being prudent. After that, we'll walk through a full 2-year example to see it in action, and we'll wrap up with a quick look at how you can actually manage this risk. Okay, let's get right into it. First up, what exactly is an irrecoverable debt, and what are the specific accounting steps we need to take when one pops up? An irrecoverable debt, you'll also hear it called a bad debt, is basically a confirmed loss. This isn't a guess. This is when you know for sure that a customer isn't going to pay you what they owe. It's time to take it off the books. So how do we actually handle this in the books? It's a really clean 2-step process. First, you have to recognize it's a loss. You do that by debiting an expense account, let's call it irrecoverable debts, and crediting your trade receivables asset. Boom, the debt is gone from your receivables. Then, at the end of the year, you move that expense over to the income statement. This makes sure your profit is accurately reduced to reflect the loss. But hey, what if you get a surprise? A customer whose debt you totally wrote off suddenly shows up and pays. That's a great day. In accounting, we call this a bad debt recovered, and we get to treat it as income. Now, you can't just put the cash in the back and call it a day. The rules say we have to do this properly, again, in 2 steps. First, you have to bring the debt back to life. You do this by debiting trade receivables and crediting a special income account, bad debt recovered. Now the debt exists again. Then, in step 2, you record the cash coming in, which finally clears that reinstated debt. Okay, so far we've only talked about debts that we know for certain are gone. But what about the ones we're just suspicious about? This leads us straight into our next section, making provisions. We're moving from certainty into the world of smart estimation. A provision for doubtful debts is basically an educated guess. It's an estimate of how much money from our current sales we think might not get collected down the road. Why do we do this? Simple. It stops us from overstating our assets and our profit, giving a more realistic picture of the business. And this right here, this is a perfect example of a huge accounting idea called the prudence concept. It basically means you should plan for the worst. You recognize potential losses as soon as you see them coming, not when they actually happen. It's about being cautious and not painting an overly rosy picture. Now, this is probably the most important part to remember about provisions, so lean in. You don't expense the whole amount of the provision each year. You only account for the change in the provision. So if your estimate of bad debts goes up, that increase is an expense. But if things are looking better and your estimate goes down, that decrease actually counts as income. It's all about the movement from last year to this year. All right, enough with the theory. Let's make this stuff concrete. We're going to apply all these rules to a real-world year 1 example for a company called NT. This will show us how to handle a real write-off and create a provision from scratch. So here's the setup for year 1. We've got total trade receivables of $91,500. We also know that one customer, LW, definitely isn't paying their $2,500. Our job is to write that off and then create a 5% provision for doubtful debts on whatever is left. The math here is straightforward, but the order is critical. First things first, you have to remove the debt you know is bad. So we take our $91,500, subtract LW's $2,500, and that leaves us with $89,000. It's that number that we apply our 5% estimate to, which gives us our required provision of $4,575. So how does this hit our profit? If we peek at the income statement, we see 2 separate expenses. First, there's the specific $2,500 bad debt we wrote off. Then, there's the entire $4,575 for the new provision. Since this is year 1 and we started with a provision of 0, the whole thing is considered an increase, and therefore it's a full expense. And here's how it all looks on the statement of financial position. Under our current assets, we report our adjusted trade receivables of $89,000. Right below that, we subtract our provision of $4,575. This gives us a much more realistic net trade receivables figure of $84,425. This is the amount of cash we actually expect to collect. Let's keep the story going. We'll follow NT into its second year. Now we get to see how the ledger accounts, the T accounts, are updated year after year, which is really where the action is. Here we're zooming in on a single customer, PB. They started the year owing $1,000. Good news, they paid off $400. Bad news, the remaining $600 had to be written off as an irrecoverable debt that balances and closes their account for good. Think of the irrecoverable debts T account as a holding pen. It collects all the specific write-offs that happen throughout the year. You can see the $600 from PB plus another $2,500 from other customers. At the end of the year, we total it all up, $3,100, and transfer that total expense to the income statement. Okay, now for the provision account. This is often the trickiest one, but let's walk through it. We started the year with an opening balance of $4,575. That's from last year. Now, after our new calculations, we've decided we need a closing balance of $5,500. So, how do we get from $4,575 to $5,500? We have to increase it by $925. And that $925 is the only number that goes to the income statement as an expense this year. The final $5,500 balance is just carried down to start year 3. Okay, we've covered the accounting side pretty thoroughly, so for our last section, let's switch hats from accountant to manager. How can a business try to stop these bad debts from happening in the first place? Well, you've got some tough choices. You could start charging interest on overdue accounts. That might get people to pay up faster, but you also risk annoying them and sending them to a competitor. Or you could take a harder line and just stop supplying them. That immediately cuts your risk, for sure, but it also means you lose every single future sale from that customer. It's a real trade-off. So, at the end of the day, there's no magic bullet. It all comes down to a balancing act. You need strong financial controls to protect your cash, but you also need to be flexible enough to keep your customers happy and keep the sales coming in. And that leaves us with one final thought. Getting the accounting right is absolutely essential, but realizing that managing credit risk is a core business strategy, not just a bookkeeping chore, is what really separates the businesses that thrive from the ones that struggle.